Hello learners, welcome to our session today. I am your instructor CPA Ringo Frederick. Today's class I want us to do a random revision looking at some of the concepts in management accounting, and specifically our focus of today I want us to talk about basically budget and variances. And in this case, variances in the event that maybe you aren't given, say, like the number of kg required to produce a certain unit. So I'm going to handle a question. That is a question from one of the papers in Nairobi University, Principles of Management Accounting, and these are question. These are question here. I'm sharing it here on our screen, believing that all of us were able to view that question. Like going straight to that question, part A, this is what you're asked, that we should explain the difference between a fixed and a flexible budget, stating which one is more appropriate for budgetary control. So number one, ideally here, the examiner wants us to give the difference between flexible budget and a fixed budget. So basically, the examiner wants us to give the differences between flexible budget, and fixed budget. By now, I know we are very familiar with this concept of flexible and fixed budget. And anytime you are talking about fixed budget, you'll find that this budget is a budget that has been designed in a way that it won't change. You can't adjust it. Whereas for flexible budget, you'll find that this is a budget that has been designed in a way that it can be adjusted. So in a very simple manner, at this point, you're looking at a fixed budget as a budget that doesn't change due to any change in activity. This is a budget. Anytime you talk of a fixed budget, basically, anytime you talk of a fixed budget, we are looking at a budget that doesn't change due to any change in activity level or output level. So this one, it does not change. Does not change. This one, we are saying it does not change. It does not change in activity level, or rather output level, Whereas anytime you talk of a flexible budget, you'll find that for flexible budget, in this case, anytime you talk of a flexible budget, you'll find that this is a budget that changes as per the activity. Is a budget that changes, a budget that changes as per the activity level. As per the activity level or production of units, or rather production of units. So you'll find that for fixed budget, it will not change. Whereas for flexible budget, it normally tends to do what it normally tends to change. And that's the main difference between these two forms of budgets. And clearly, I can give you a very clear distinction in form of a table. Probably I just dictate, and you guys, you should be putting it down. So anytime you talk of, again, the difference between these two forms of budget, whereby I'm talking of a fixed budget here, and you're talking of a flexible budget at this point. Flexible budget at that point, flexible budget, of course. And at this point, let us look at the points of differences, or rather the basis. Points of differences or basis of distinction. The first thing that we should be very familiar with in regard to the basis at this point, we can start with the level of activity, just as what we've mentioned right now, right? We can start with basis. Number one, basis is a level of activity. Level of activity. You'll find that a fixed budget is what you can put it down. If you're putting it down, it is prepared for only single level of activity. Prepared for only single. prepared for only single level of activity. Prepare for only single level of activity, because you see that it does not change in the activity level or other output level. So it is prepared for a single level of activity. Whereas for flexible budget, my good students, you're saying that it is prepared for different levels of activity. It is prepared for a different level of activities. It is prepared for different level of activities. It is prepared for different level of activities. That is an aspect to do the flexible budget. So that was our basis number 1 of difference. Basis number 2, my good students, so you can put it down as well. We are looking at in terms of the nature. In terms of nature. In terms of nature. At this point, you can handle it in so many points, right? In terms of nature, you'll find that it is static in nature. That is fixed budget, static in nature, assuming business condition will remain the same. So this one is static in nature. Static in nature, assuming that the business activities will tend to remain the same. It assumes that business activity will not change. Whereas for flexible, you find that it is dynamic in nature, assuming business condition will change. So this one is dynamic in nature. So this one is dynamic in nature, assuming that business condition will do what? Will change. Number 3 point of difference, you can talk of the aspect of cost classification. Cost classification. Cost classification. Under fixed budget, you will realize that under fixed budget, my good students, cost is not classified. At this point, you just be taking your figures randomly. There is no need of classifying our cost. So cost is not classified here. Cost is not classified. Cost is not classified. Whereas for flexible budget, you'll find that cost is classified. Cost is classified. Cost is classified into either fixed cost, variable cost, or even semi-variable cost. That is the point of difference number 3. We can go on and go on and go on. Talk about aspect to do with the use. How is it being used? Talk about aspect of variance analysis and so many other point of difference. Say for example, like when you are talking of on the basis of variance analysis, because also our next concept will also be looking at variance analysis. On the basis of variance analysis, you want to distinguish your fixed budget and a flexible budget in terms of variance analysis. You'll find that variance analysis does not give useful information as all cost, that is under fixed budget. Whereas under flexible budget, you'll find that variance analysis gives useful information as cost is analyzed according to their behavior. Fixed budget, you're not going to analyze our cost according, or rather in this case, you find that this analysis actually won't do all this analysis. But on flexible budget, you'll find that you'll have to analyze our data, of course, based on their cost behavior, and so many other points of difference you can have there. So that is point 1 we've answered, whereby you're asked to kind of give the difference between, of course, the aspect of fixed budget and flexible budget. So just based on all that we've explained, if you're asked here, my good students, to state which one is more appropriate for budgetary control, surely, which one can you say? Just from all the definition and the difference that we've looked at. If at all you had to talk of a budgetary control, which one is more appropriate? Of course, flexible budget is appropriate for budgetary control. Flexible budget is appropriate for budgetary control. So that is point number 1. We are done with it, and I believe you are very satisfied with the point with part A of the question. Let us proceed to part B of the question. What are we asked part B of the question? What are we asked in part B of this question? Believing that this question is clear, though somehow dark, but I believe we're able to view it clearly. Part B of the question, these are what you are told, my good students, that the following details have been extracted from the standard cost card. Look at that case, from the standard cost card, of product X, which is manufactured by the XYZ chemical company, which uses an absorption costing system. So I'm told that this company uses absorption costing system, meaning that I'll always come up with a cost data based on the basis of absorption. So this is what you are told. Standard cost card. Of course, standard is the same as budgeted. I'm told that you're having direct material. We do have direct labor, variable overhead, and you do have what? The fixed overhead. In addition to that, you are told that the fixed overhead charged to each unit, of the product is based on a monthly production and sales of 2,000 units. It is based on a monthly production and sales of 2,000 units. The budgeted selling price of product X is 35 shillings per unit. What you realize up to that point, my good students, and that is the trickiest part with that question, even before Mwalimu continues to the required and the other elements, you realize that anytime you are talking of variance analysis, it is always very appropriate for us to distinguish between the unit of measure and the units produced, the actual output. We normally tend to talk of these elements. In this case, we are told, or rather maybe let me explain that concept first of all. We normally tend to talk of units. These are output. Completed units. These are complete units. Then we normally tend to talk of components. So components of production, we normally tend to talk of either materials. In this case, we normally tend to talk of labor, for example, at that point. And in this case, maybe I'm talking of a unit of measure, like maybe kgs, like grams, liters, etc. Whereas labor, I'm talking of the number of hours that we're going to use to produce, say, like 1 unit. So you'll find that there's a clear difference between output and components. So in this case of hours, many a times in most of the question, you can be told that maybe I was using one component, 1 kg, going for shillings, say like 4 shillings to produce 1 unit. So whereby in this case, you find that in a unit production here, I'll be having 4. Other case, you can be told that for me to produce 1 unit, I require, say, like 2 kgs. And each kg is going for 4 shillings. In this case, you'll find that the cost for the unit, I should be having 8 shillings. So this is a component of production. And this, the total number, or rather this is what? The unit final product, the final product output. So it is very important to know that there is always a distinction between the component of production and the final output. The trickiest part of this question is that we are just given the final output. You aren't given that component of production. So that's the trickiest part. But the examiner here had guided us. He had mentioned that you're using what? Absorption costing. You're using absorption costing. So we'll see how we'll treat that. So at this point, I'm also told that during October, the actual production and sales amounted to 250 units, and cost incurred and sales revenue achieved were as follows. So I'm given the figure there. So what you should understand that is at this point, I am going to assume that this, whatever I'm given as the final output, were the same components that we used as what? Components of production. If it is hours, if it is aspect of material. So it's as if you're assuming, like if I was to explain the first component there for direct labor in this question, this is what you're going to take. And this is an assumption. Given that, assuming that this question didn't have any mistake, this is an assumption that you're going to make. And actually, you can make that assumption. We are going to say that we are assuming that, for direct material, this is what Mwalimu is saying. For direct material, in this case, you're assuming that we needed 1 kg, or rather one component, assuming 1 kg, at 8.40. So that's why I'm having 8.4. So that's why I'm talking of, I'm assuming it's one unit of measure. If it's 1 kg, 1 gram, or whichever unit of measure that we'll be using. The same case with direct labor. So I'm assuming that maybe I'm having 1 hour, each going at how much? Each going at 7.60. So that is what you're going to have. So that I'm having 7.60. Okay. Now, once we have that in mind, we are given our actual data there. Then required here, you are told to calculate the following variances: direct material total variances, direct labor total variances, overhead total variance. So given such a question, my good student, the first thing that we should do, of course, always is to do what? Is to smile. Is to smile. And why should we smile? We should smile because here, we can either use the long route or we can use the shorter route. So let me use the shorter route. Right? So first of all, let us start with our variances. And in this case, with any order, I want to start with the sales variances. Specifically to that question you asked, sales price variance. For me to determine my sales price variance, of course, you know very well that what I'm required to do is, this is a sales price variance. I know I'll be comparing my prices in terms of what? The standard selling price minus our actual selling price times the actual quantity of units sold times the actual quantity of units sold. So in this case, this is to say, remember this case I'm doing a selling price. Actually, I've started with the last bit. That is part D of the question, right? That is a selling price variance. We are asked, this is a selling price. This is a selling price variance. This is what I've started with. Selling price variance. So I'm having that case. Now, after having that case, we do have actual quantity of our material is actual quantity of the units that we sold. If you can check in our notes, check that data below our actual. During October, the actual production and sales amounted to how much? 2150 units. 2150, right? Selling price per unit amounted to how much? Standard selling price. Budgeted. Budgeted, you are told that the budgeted selling price of product X is 35. And what about our actual selling price? Our actual selling price, how will you determine our actual selling price? Our actual selling price, I'm given the sales revenue, which was 68,800. Clearly, you can see that the sales revenue, 68,800, right? We divide this one by the number of units that we sold, which was 2150. So this clearly will give us our actual selling price. And our actual selling price will be how much, my good students? My actual selling price will be 68,800. We divide by 2150 to give us a figure of 32. So I'm going to have here 32. After having that case, clearly you can come and determine our selling price, or rather our selling price variance. So my selling price variance here, I should be having actual quantity, which is 2150, into standard selling price, which is 35, minus actual selling price, which is 32. So clearly I can see I sold more than what I had budgeted, right? In this case, we sold less than what we had budgeted. I had budgeted to sell each unit at 35 shillings. But you ended up selling our unit at how much? 32. So of course that is what? An adverse variance. Receiving a revenue less than what I had anticipated. So therefore I'm having 35 minus 32 times 2150 to give us 6450, 6,450. This one is an adverse variance. Mark that very well. That is an adverse variance. You had budgeted to sell your product at 35, but you ended up selling at how much? 32. So I'm having 6450, which is adverse, That's why I'm having 6450 adverse. Then we proceed to the next bit here. Excuse me, let us jump straight to part A. direct material total variance. Direct material total variance. So direct material total variance. Direct material total variance. How will we work it out? Recall, for you to determine your total material total variance, just recall this formula. The standard quantity of our material times the standard price of our material. We less what? Our actual quantity of our material times our actual price of our material. As simple as that. That is what you need to know. 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 Still, alternatively, you can take your material total variance. You can take your talk over material price variance plus material usage variance. You can have this formula as well. This one is the longest, this one is the easiest. You can either use these two formula, either the standard quantity times the standard price minus actual quantity times the actual price, or material price variance plus material usage variance. That one is the longest, right? Let us make our work to be easy. Let us use the first one here. We know very well that I'll never be given our SQ. That one for sure, we know very well. You'll never be given your standard quantity. And how will you determine your standard quantity? To determine your standard quantity, normally tend to talk of what? Our standard quantity per unit, standard quantity per unit, times our actual units, Remember, at this point, my good students, we weren't given this one. We weren't given anything to do with the unit of measure. And that's why Mwalimu was saying that we can take what? One per. Each one per. We're assuming that it is one per. So therefore, I'm going to take 1 times our actual units in our case. How many units did you actually produce? Our actual quantity, we can clearly see we are given 2150. So therefore, I'm going to have 1 by 2150, which will give me 2150. So this is my standard quantity. That will be our standard quantity. Our task here is to determine our material total variance. So easy way of doing that, I'm going to say my material total variance therefore is equal to our SQ, which I've taken 2150. We multiply by the standard price. What was our standard price of our material? In this case, what was our standard price of the material? We are going to take the figure that was given per unit because we can't get it anywhere. So I'm going to take the 8.40 to be our standard quantity of our material. Because remember, as I mentioned from the word go, if we could have been given per unit, assuming if I could have been given 1 kg at, say, in this case, we are assuming that assuming 1 kg at 8.40 to give us the 8.40. So this is the standard price per our unit of measure. Okay? And in this case, if I was given, say, like 2 kg at 4 shillings to give us what? 8. This will have been our standard price of our material will have been 4 shillings, right? So therefore, in this case, I'm taking 8.4 because you aren't given these items. And that's why Mwalimu is assuming that you're given 1 each. So therefore, we're going to take 2150 times 8.40. We less what? We are going to deduct our actual quantity, which in this case, you're given 2000. We multiply by what? We multiply here by 8 point. That is not 8 point, but actual quantity. And that is the most, that's another interesting area that I want us to open our mind wide. Go to your data where I was told that the actual direct material cost, you can see I was given how much? 18,100. Our actual data, I was given I was given 81, I was given 18,100. That is the total. And for this was for how many units? Because our units, you say, is the same case as our kg. So our units in this case, I'm given how much? I'm given a figure of 18,100 for production of 2150 units. So actually this was our actual, which was 2150. So therefore I'm going to take 18,100, 18,100 divide by 2150 to give me 8.4. 8.4186. 8.4186, and the figures that I'm given there. Alternatively, if you were to take at 2 decimal place, you'll find that I'll be having a zero variance. You could be having any form of variance. So therefore, I'll just take the way it is like that. So that in that case, I'm having times 2150, 18,100, which is the same figure that I was given, by the way, if you can check it out clearly, right? The same figure that I was given, our actual, 18,100. See our actual there. See our actual. It's taking us back to the same. Our actual, we are given 18,100. So in this case, it's as if you are talking, or rather you can agree, it's as if I'll just take the same figure here. 18,100. 18,100. So that in this case, my variance will be how much? We should be talking of 2150 minus 8.40. 2150 times 8.40 minus 18,100. So in this case, I can clearly see I'm getting a variance of 40, and that is an adverse. That is adverse. That is adverse. That is adverse. Adverse of 40, because we are spending more than what we had anticipated. We are spending more than what we had anticipated. So that is what we do have as our material total variance. The other bit, the same concept will apply. Let us now determine our material, or rather labor cost variance. Direct total, or rather, what was the question? Let me see. Direct labor total variance. Direct labor total variance. The same case, we do have two ways of determining that. We do have the two ways of determining that, where in this case, my good students, we normally tend to talk of what? Direct, or rather labor total variance. We normally tend to talk of our standard hours times our standard, times our standard rate, we less what? Our actual hours times our actual rate. That is what we normally tend to talk about. Still, alternatively, labor total variance, you can take your labor rate variance, you add your labor efficiency variance. That is a long route that we wouldn't want to wish to take that long route, because you aren't asked for individuals. I would just ask labor total variance, right? So the same case, you know very well that we'll never be given our SH. And to determine our SH, normally tend to talk of what? Our standard hour per unit times our actual hours, Remember at this point, these items you are not given. So you are just going to assume that it is the same as our number of units that you are given. So therefore, my SH is the same as I'm talking of 1 by 2150. In that case, which will give us what? 2150. Because this is standard hour per unit, I'm assuming the one that I was given, we multiply by 2150. That is what I'm getting as a standard hours of 2150. So therefore, my labor rate variance here, not labor rate, but total, labor total variance, I'm going to have our SH, which is 2150. I need a good student to give me our standard rate. What was I given as our standard rate in that question? Standard rate in that question, I can clearly see I was given a figure of how much. Direct labor, 7.60. I less our actual direct labor cost. I was given 49.80. Direct labor 49.80. I'm going to take it directly because it's the same concept as what you had looked at earlier on under material. So therefore, at this point, I should be having 21.50. We multiply by 7.60 minus 14.980. This should give us 1360. This should give us 1360. And the question is it adverse or, let me excuse that question there. Is it adverse variance or is it a favorable variance? So I'd plan to spend, look at this case. I'd plan to spend 16,000. I'd plan to spend 16,340. But you ended up spending 14,980. So that is to say, I spent less than what I had planned. Therefore, giving us what? A favorable variance. Assuming you had planned to spend 16,000, but you ended up spending only 14,000. So it means that you are saving. It means that that variance is in favor of you. It means that that variance is in favor of you. So you're done with that part, actually, just as simple as that. Proceed to the next bit. In this case, I'm giving you guys the easiest way of working out variance analysis, right? So proceeding to the next bit, here you're asked to compute what? You're asked to compute overhead total variance. You're asked to compute overhead total variance. So overhead total variance, my good students, if you're asked to compute your overhead total variance, what should come at the back of your mind is I should be talking of variable overhead variance. We add our fixed overhead variances. I should be combining the two to give us a total overhead variances. And at this point, it means that we need to compute each one separate. We need to compute each one separate. So this is to say that we start with variable overhead variance, where I'll be talking of two. Number one, we are going to start with this variance known as what? We are going to start with this variance known as variable overhead efficiency variance. We proceed to variable overhead expenditure variance. That is what you should be having at the back of our mind. That is what you should be having at the back of our mind always, 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 always. So therefore, let us proceed to work out our variable overhead expenditure variance and efficiency variance. So we are going to start with, of course, variable. I need to have it here as variable overhead efficiency variance. Variable overhead efficiency variance. So to determine our variable overhead efficiency variance, my good student, what you should be having at the back of our mind is the concept of efficiency. We want to compare our hours, and therefore this is what you'll be expected to do. I'm going to take our standard variable overhead absorption rate per hour. Allow me to remove this question here. I'm going to take our standard variable overhead absorption rate per hour into our standard hours minus our actual hours. Standard hours minus our actual hours. Standard hours minus our actual hours. So this is to say, my good students, this is what you should be having. Standard variable overhead absorption rate. What was I given on top there? Look at the question there. Believing that you've already taken the question with you. I was given, in this case, I was given standard variable 3.90 into our standard hour. In this case, I'm having 2150, which we had computed there, minus our actual hours, which is 2150. So this is to say that at this point, variable overhead efficiency variance, I'm going to have 0. We don't have any variance. I'm going to have 0. I'm going to have 0. I'm going to have 0. So therefore, we are done with that part. 0. Variable overhead expenditure variance. Variable overhead expenditure variance. Variable overhead expenditure variance. I should be talking of variable overhead expenditure variance. My good students, recall, we're going to talk of our standard variable overhead absorption rate per hour. I multiply by what? Our actual hours. I multiply by our actual hours. In this case, we less what? Our standard, or rather our budgeted variable overheads. We less our actual variable OHDs. I'm trying to squeeze so that it can fit very well. So therefore, this is what you should be having. This is what you should be having, my good students. This is what you should be having. I'm going to have our standard variable overhead absorption rate. In that case, I was given directly there. This is what I was given. Let me share the question. I'll squeeze the question on top so that you all have it there. Yeah, you see, I was given a figure of how much? I was given here a figure of 9 point. I was given a figure of that is 3.9. So I'm having 3.9, same figures what we had looked at there, 3.9. So I'm having here 3.9 times our actual hours, 2150. We less our actual variable overheads. I was given a figure for much? 8160. 8160. So therefore, that is to say we should be having a figure for much? I'm having 3.90 times 8160 minus, that is 2150, sorry, times 3.90 minus 8160. I'm getting a figure of 225, which in this case, this is what? Favorable, F, which is favorable, F, because I'd planned to spend 3.9 times 2150. I'd planned to spend 83.85, but you ended up spending 81.60. So I am saving. So I am saving. So this is the first data that I'm going to have. Variable overhead expenditure variance. I'm having 225 favorable. 225 favorable. 225 favorable. We proceed to fixed overhead expenditure variance. Fixed overhead expenditure variance. Fixed overhead expenditure variance. Fixed overhead expenditure variance, where I should be talking of budgeted OHDs minus our actual OHDs, right? So budgeted overheads. How much do we have as our budgeted fixed overheads? Budgeted fixed overheads, determining that will be simple, because I'll be taking, my good students, fixed overhead, which was 5.10. I multiply by the budgeted units, which was 2000. We less what? Our actual fixed overheads. I was given 9950 there. 9950. So therefore, what should we be having? I should be talking of 5.10 times 2000 minus 9950 to give us a figure of how much? 250, which is what? Favorable. Which is favorable. Which is favorable. So therefore, 250 favorable. That is fixed overhead expenditure variance. We proceed to the next item, volume variance, volume variance, volume variance, volume variance. Therefore, for volume variance, this is what you're going to do. I'm doing all of them here. Fixed overhead volume variance. We should know very well that I'll be talking of our standard fixed overhead absorption rate per unit into what? Into our budgeted output minus our actual output. So that will be very simple, because standard variable overhead absorption rate, take the figure that you're given direct there. In our statement, I was given 5.10, right? So I'm having 5.10 into what? Budgeted output 2000 minus actual output 2150. So this will act opposite. Volume variance, remember, is a special cost variance. So I had budgeted to produce 2000, but we ended up producing 2150. So you can clearly see I'm having what? A favorable variance of how much? 2000 minus 2150 times 5.10 to give us 765. 765 favorable. 765 favorable. So confidently, I can remove this figure here. I can remove our paper there, and mentioning that this is what we should be having, right? So this is a fixed overhead volume variance. This was a variable overhead expenditure variance. So we totaled the three. To total the three, I should be having 225 plus 250 plus 765. I should be talking of 1240 favorable. 1240 favorable. 1240 favorable. And that is what we are required to do in that question of ours, my good students. That is what you are required to do in that question of ours. You're given 25 marks, and that is what you're required to do. So if at all you have any question, of course, you can always engage, but basically that is what you're required to do in that question of ours. So to that point, guys, thank you so much, and see you in our next class. Thank you.